the chart we just saw, trending below budget. We are budgeting for the year total revenues of $239 million. So that's represented by the blue line there. Looking at our expenses, this chart is showing salaries and benefits expenses. So for the first 2 months of the year, we had expenses of just under 38 million. You know, given the scale of the chart, it looks pretty close to being on that blue budget line, and it is. I will tell you, it's a little bit over the blue budget line. We have seen some higher expenses than we anticipated for overtime in July and August, so that's something else that we're going to be monitoring as we go through the year, and may result in adjustment at mid-year. But right now, it's just putting us a little bit over the budget line. And for the year as a whole, we're budgeting for about 195 million in salaries and benefits expenses.
Amanda, if I may, is that overtime higher than expected due to the deployments this summer, or is there some other thought you have on that?
So good question. Certainly deployments are resulting in higher overtime year over year, but we had anticipated that in the budget number. So that's accounting for part of the difference between the red line and the green line, which is prior year, but not so much any difference that we might be seeing between budget and actual. I think what we are seeing is obviously there's been increased workers' compensation time as a result of COVID exposures. That's contributed. And additionally, just some of our other leaves like sick leave and vacation, the usage was higher than what we would have anticipated based on prior year activity. So we'll just that may have been an aberration for these first couple of months, and it's kind of something we just need to see how that develops throughout the year.
Thank you.
Director Wood?
Yes.
This is just Todd. You know, I think Amanda said that we saw a big decrease in vacation and sick leave usage. And if you think about July and August, we saw all the vacation spots fill up. We saw people off on COVID, but we have seen an increased use in sick leave. And there's a number of different, thought process behind those. But the leave usage has gone up, especially in those first 2 months of this budget year in there, and I think we're seeing it on there for the overtime backfill for those positions.
All right, thank you, Chief. Thanks. Sorry to interrupt you, Amanda.
No, great question. Thank you. All right. So now just kind of looking overall at expenditures. So this is including salaries and benefits, services and supplies, other expenditures. So we're at just under $52 million for the first couple of months, and that's shown on the red line. Pretty much tracking right on budget. So the budget being the blue line there. Overall, we're budgeting for $237 million in expenditures for the year as a whole. And I think really what we're seeing is that while we're over a little bit on salaries and benefits, we're kind of under a little bit on services and supplies. So those things are balancing each other out for the first couple of months. So this chart is showing general fund reserves, and just as a reminder, the way that we're calculating this is starting reserve balance, adding our revenues, subtracting our expenditures. So the green line is really showing, we started at roughly $35 million at the beginning of the year, as we expect, and as is shown, in the pattern of the red line, which is last year. We know that that's going to drop down in the first part of the year when we're spending more money than we're taking in, because we haven't gotten the first installment of property tax revenues yet. So we're sort of following that same pattern this year as we would have expected. So we're actually in a negative reserve position as of August 31st. However, by the end of the fiscal year, we are projecting a reserve balance based on our estimated starting balance and our budgeted revenues and expenditures of $37 million, which would equate to about 16% of our net budgeted expenditures for the year. And that's represented by that dashed yellow line on this chart. This chart is showing a total cash balance for all district funds. So again, this is not just the general fund, and it's also not a reserve number, but an actual cash number. How much cash do we have in the accounts? And you can see the green line is representing the current fiscal year. So as of the end of August, we had just under $6 million. A little bit lower than the same point in time last year, which I think is attributable to the fact that we've had lower revenues coming in the first couple of months of this year relative to last year, and also some of our larger payments that we make, cash payments that we make at the beginning of the year that are recognized as expenses throughout the year, but are a cash outlay at the beginning of the year, such as our CALPERS unfunded liability payment was higher than it was last year as well. So those are some of the things that are attributing to the difference in cash, but overall relatively comparable to where we were at the same point in time last year. And then finally, looking at the CERBT fund. So as you know, this is our OPEB trust fund. It's not represented in the cash balance that I just showed you because this is a fund that's held outside of the district. And the money in this fund can only be used to pay future retiree medical premiums. So the balance as of August 31st was $54 million. That was contributions of $40 million and earnings over the life of the fund of a little under $14 million. I think, what's interesting to look at on this chart is, that green portion is representing the interest earnings. And, certainly earlier this year in the spring, we saw this big dip. But you can see more than recovered since then. And obviously the more money we have in the fund, the more sensitive we are to what that investment performance is. So the interest earnings are becoming a more significant portion of the balance of the fund. And obviously, will be important for the future performance of our OPEB funding. And let's see, I'll just kind of wrap up with a bit of a summary. So as I mentioned, revenues are trending a little bit below budget due to medic cost recovery activity. Our expenditures overall are trending on budget. And then our fiscal year 2020-21 ending reserve balance is expected to be $37 million or 16% of our net budgeted expenditures. And that concludes this presentation. I'm happy to take any other questions you might have.
That's outstanding. Again, I appreciate the OPEB slide. That's always what we used to call the ARC is such an important piece of data for me. So I appreciate that. Any questions from any of the other directors?
No, Mr. Chair. Thank you very much, CFO Amanda Thomas. All the info is great. I agree with the chair.
No, none for me. It looks wonderful.
Thank you so much. Moving on, you still have the floor, Amanda.
I do. So let me try to transition to my next presentation. So I'm going to stop this one and try to start another one. Let's see. Okay. Are you all seeing a different PowerPoint presentation now?
Affirmative.
Okay. So the next item that I have to present this evening is the district's CalPERS annual evaluations as of June 30th, 2019. So as I think you know, there's a couple of year lag built into the CalPERS valuations relative to when the contributions that are determined by those valuations are due. So these are the valuations that were just completed. They're for the year that ended June 30th, 2019, and they will impact the contributions that we make for the fiscal year 21-22. So not the current budget year, but next budget year. Just in terms of the overview of what I'm planning to cover in this presentation, first I'll just talk a little bit about the plans that we have with CalPERS. I'll give you a little bit of a background on actuarial methods and terminology. I know that's everybody's favorite thing to talk about. And then just do a summary of the valuations as of June 30th, 2019. Again, those will have an impact to the contributions beginning fiscal year 21-22, and then talk some about what we anticipate in terms of future contributions based on those most recent actuarial valuations. So just starting off, this kind of gives an overview of the CalPERS plans that we have. So we have a safety plan, which is a plan that includes both Classic and PEPRA members. So we don't have separate Classic and PEPRA plans for safety, but we have one plan that includes both members, both types of members. And then obviously the benefits are different. So the Classic benefit is 3% at 50, that's the formula. And the PEPRA benefit is 2.7 at 57. And the way that it works, you know, with a, what CalPERS calls a non-pooled plan is that the normal cost rate that the district pays is effectively a blended normal cost that reflects the cost, the relative cost of the PEPRA and the Classic members in the plan. So we pay one normal cost rate regardless of whether somebody is a Classic or a PEPRA member, but that rate is calculated to account for the fact that there's a difference in those benefits. And then we participate in the CalPERS pooled plans for miscellaneous members. So our miscellaneous benefit is 3% at 60, and then also a separate pooled plan for PEPRA miscellaneous members, and that benefit is 2% at 62. If you look at the pie charts on this slide, you can see whether you're looking at it in terms of members or liability, that you know, which should surprise no one, that our safety plan, you know, really accounts for the majority of what we're talking about here. So 83% of total members, and these are all members in the plan, so active, retired, transferred, and then the safety plan accounts for about 95% of the actuarial accrued liability. So a lot of what I'm going to be talking about throughout this presentation really pertains directly to the safety plan, mostly because that's where the majority of the members' liability and cost are. Okay, so here's the kind of the quick overview on actuarial cost method and terminology. So CalPERS uses what's called the entry age normal cost method of determining liability. So what that means is that they project benefits for each member in the plan, and then they spread the costs associated with those benefits in a way that produces level annual cost as a percentage of pay over that particular member's working life. So every year from their age of hire to their assumed retirement age. And then once they do that, they look at the cost associated with the current fiscal year, and that's what's called the normal cost. So that's the cost of the projected benefit that's allocated to the current year. And also look at what's called the actuarial accrued liability. And that is the cost that was allocated to all prior years. So for an active member, they have a projected benefit that has costs spread from the age they were hired to their assumed retirement age. And the actuarial accrued liability is going to be the cost from the age they were hired until the current year. So the cost that's allocated to future years is not part of the actuarial accrued liability. For all retired members, the actuarial accrued liability is equal to the projected benefit, right? Because they have no more working years left. Then the other piece is, so that kind of talks about the liabilities. The other piece is, what are the assets? So market value of assets, that equals the total savings. That's the total amount that, that is available to pay benefits based on contributions and interest earnings. So what becomes an important thing to look at in the valuation is, what is the unfunded actuarial accrued liability? And that is the sum of all of the actuarial accrued liability for all of the members minus the total amount that's available to pay benefits, that market value of assets. So that's the actuarial accrued liability minus the market value of assets gives you the unfunded actuarial accrued liability, or UAAL. Okay. So, so the other important thing when we're talking about actuarial valuations is that obviously they're based on assumptions, right? So the determination of projected benefits it results from the assumptions that are made. And one of the most important assumptions that you may be familiar with is what's called the discount rate. That's the assumed rate of investment return. So that's important because that's what gets used to express the projected benefits in today's dollars, right? The present value, because you get to discount it back to today at the assumed rate of investment earnings. So the higher that rate, the more of a discount, meaning the lower the amount is in today's dollars, the lower the rate, the opposite happens. So the discount rate was, as you know, reduced over the last several years from 7.5% to what is the now 7% discount rate assumption. Another important assumption is assumptions about salary growth. So CalPERS uses a general wage inflation assumption of 2.75% kind of across the board, but that gets added to assumptions that vary by category, entry age, and years of service that account for things like promotions and step increases and those sorts of things. So those really vary based on the specific demographics of that particular member in terms of what CalPERS would assume. And then they also have a 2.5% inflation assumption. That's important for what the inflation of benefits would be, so the COLA for benefits. So those are the main economic assumptions. And then there are demographic assumptions about terminations, deaths, disabilities, retirements. So many complicated actuarial tables go into producing all of those assumptions. So, so I talked about the discount rate being an assumption, and the fact that that went from 7.5% to 7%. And I think this is I think a good graphic that CalPERS has done for a while now that shows for every dollar that gets paid to a CalPERS retiree, and this isn't specific to our plan or our members, it's just kind of an average for CalPERS as a whole. How did that dollar get funded? So 3 years ago, before that discount rate assumption, the way that broke out was it was 65 cents of that dollar came from investment earnings, 22 cents from CalPERS employers, and 13 cents from CalPERS members. But if you go and look at it today, I just pulled this off their website this week, you can see now with that a reduced assumption about what investment earnings are going to be, that now instead of 65 cents of every dollar coming from investment earnings, it's 55 cents coming from investment earnings. So that additional 10 cents has come from employer contributions, which has gone from 22 cents to 32 cents. And then members are staying at about 13 cents. So I thought that was an interesting sort of visual that shows what the impact of that assumption is. So the other thing besides assumptions is how do actual results perform relative to assumptions. So that's really what they're looking at when they do these actuarial valuations, and just kind of sticking with the, the rate of investment return and the discount rate. This chart is showing with the horizontal lines being what the assumed rate of return was in each year, and the bars being what the actual investment return was. That, in every year there is a difference between what was assumed and what actually occurred. And what happens through the actuarial valuation process is they're looking at what is the impact of that difference on the unfunded liability. So in years where the investment return was higher than what was assumed, that's going to create a gain, which reduces the unfunded liability and actually, reduces what would need to be contributed in the future. And in every year where there's a loss, that's going to increase the unfunded liability and increase contributions that need to be made. So this is really just showing that, that happens in every year. And I think with what CalPERS has tried to do through its reductions to the discount rate is get to a discount rate that they feel is a reasonable long-term rate that can be achieved, and minimize the opportunity that losses are going to be created in future years. So, oops. Oh, it doesn't want to show it for me. There we go. Okay. So the annual funding requirements, what we have to pay to CalPERS, is made up of two components. It's the normal cost, right, which is the cost that's been allocated to the current year, and that we pay as a percentage of payroll. So it gets calculated as a percentage of payroll. And then the second piece of it is an amortization payment towards the UAAL, and that is a fixed dollar amount. And that UAAL payment changes each year as a result of two things. One, there are scheduled changes based on how that gain or loss was originally amortized. And then there are new gains or losses that are created by that current valuation year and how the actual results performed relative to what was assumed. So what I mean by that first item there, the scheduled changes, is that under the amortization policy that CalPERS had in place right up until this current valuation, new gains or losses were amortized, so they were spread out over a 30-year period at a level percentage of pay with a 5-year ramp up and a 5-year ramp down. So they looked like this chart here, which meant that the first year after us, you're only really paying 20% of what the ultimate annual payment is going to be. The second year, 40%, third year, 60%, fourth year, 80%, and then by that 5th year, you're paying roughly 100%, but it's still increasing here every year based on payroll because it's amortized as a level percentage of pay. So they have that increase based on payroll, and then when you get to the final 5 years, it ramps down. So you could get, theoretically, you could get to year 2, not really have any new loss created, but you're going to have more costs just because of how the amortization was done. So that contributes to year-over-year increases that aren't related to the current year gain or loss. And then there are new gains and losses that are created in the current year. So beginning with this valuation, this 2019 valuation, the CalPERS amortization policy has changed so that any new gains or losses are spread over a 20-year period. So it's a shorter period of time. And only investment gains and losses have a 5-year ramp up, but all other gains and losses have no ramp, and they are all spread as a level dollar amount, which means that the amount that you contribute in year 1 is going to be the same as the amount that you contribute in years 2 through 20, and there wouldn't be any year-over-year change just as a result of the original amortization schedule. So that only applies to new gains or losses, but it does apply starting this year in 2019.
Excuse me, Amanda and
Yeah.
Mr. Chair. This is Gay. Hey, before we get too far along, a few slides back, it showed that, simply put, employer contribution went up 50% from 22% to, or 30, I don't know what it was, 22 million, 32 million. So it was up 50%.
Oh, the cents out of the dollar?
Yes, ma'am.
Is that what you're saying?
Okay, now my question is, that increase is 50%. In the previous slide with the UAAL and the amortization, is that included in that sense of on the dollar that the increase that the employer has to pay?
So, so the reduction in the discount rate, which essentially
Yes.
says we assume that we're going to earn less from investment earnings, so investment earnings are going to contribute less to the overall benefit payments. So that increased both the normal cost and the unfunded liability contribution. And I do have some slides later on that I think will speak to that and probably make more sense once we get there. But feel free to stop me once we get there if I'm not answering your question.
Okay, thank you. Or I can also harass you offline and get more detail. Thank you.
Sure. Okay, so I'll try to get us there relatively quickly. So what this chart is showing is the basic results about our plan funded status for these June 30, 2019 valuations. So so there's a column for each of the plans, but I'll probably just speak to the safety plan. So that present value of projected benefits, right? That's the value in today's dollar of the benefits that each member will be entitled to or is estimated to be entitled to. That for the safety plan was about $1.5 billion. Actuarial accrued liability, so that's the benefits, the cost allocated to prior years, that's 1.2. And then market value of assets was 805 million. So if you take number 2 minus number 3, that's how we get to a UAAL for the safety plan of about $440 million. And then there's another important measure is the funded ratio, which is taking the actuarial value, or excuse me, the market value of assets and dividing it by the actuarial accrued liability. So what percent funded are we? For the safety plan, that was 64.5%. For the miscellaneous, it was 74.2, and for the PEPRA miscellaneous, 92.1. You know, a lot of times I get the question of, well, what should it be? What's a good number to be? I mean, the real answer is the way that pension plans are funded, the way that actuarial evaluations are done, the objective is to get to 100%. So that's, you know, that's the ultimate target. In terms of how do these results compare to average, I don't think CalPERS has published their average yet for this year, but for last year it was about 68% for safety, so we're a little bit less funded than average, and I think about 72% for miscellaneous, so a little bit better funded on the miscellaneous side to kind of help put those numbers in context a little bit. Okay, so shifting gears just a little bit and actually just help provide a little bit more context. This is a chart that I think you may remember from the budget presentation, but this is basically showing for our labor budget, you know, what are the costs that are included in our labor budget. And what we're really talking about tonight are these costs right here. So that blue box, the safety unfunded liability, which is 14% of our labor budget. The orange, which is the normal cost for classic members, and the dark blue, which is the normal cost for safety PEPRA members. So all of that together is about 20% of our labor budget. The miscellaneous plan is shown right beneath that here. That in total for both classic and PEPRA is about 1%. Which is again why I'm focusing more on the safety plan tonight, but this kind of helps put in context, you know, what we're talking about tonight. What does it mean relative to the rest of our budget? Okay, so looking at safety plan employer contributions. So first, if we look at that normal cost piece, and one of the things that I wanted to point out on this chart, and I've shown across the top, is, what was the discount rate assumption for the valuation year that produced the required contributions shown on this chart. So I think this may answer part of Director Jones' question. So we had, a 7.5% discount rate essentially through the valuation year that determined the 17-18 contributions. Then it went down to 7.375, 7.25, and then 7. So in terms of the normal costs that needed to get paid, you can see, we're in the kind of $9 to $10 million range. And then once that discount rate started ramping down, the normal cost contributions went up. So we went from 9 to 11 to 12 to 13, and that's really reflecting the fact that additional employer contributions were required because the assumption was that fewer funds would be available from future investment earnings. And then you can see going forward, and these are based on projections that are included in the CalPERS reports. This amount is expected to stay relatively steady because it's sort of based on a steady set of assumptions. And while it is a percentage of payroll, and we do expect payroll to grow over time, we also know that there will be additional PEPRA members in the plan over time, and their normal cost is lower and is bringing the average down. So normal costs we expect to be in the $13 million to $14 million range going forward. However, if we look at the other component, which is the unfunded liability contribution, that's where we have seen and we expect to see continued increases. So if you again kind of look back at the past, you can see that we're going from let's start with this current fiscal year. We have $27 million. You can see that compares to just a few years ago where we are under $20 million. So we've seen significant increases in recent years, in part because of the reduction in the discount rate. So you can see, again, as we've stepped through those years where the discount rate has been reduced, that we have also seen corresponding increases in the required unfunded liability contribution. And we expect to see those going forward as well because of the way that the loss that was created by that assumption change, as well as other losses that were created in prior years, the way that those have been amortized with the ramp up and the percentage of payroll assumption, as well as the fact that we have new losses that have been created. So I'm going to show you what that looks like in more detail in a couple of slides. But I think the important point on this slide is that we're looking at combined. So combined this year, we have contributions for the safety plan of about $40 million. Next year, we expect that to go to about $45 million. And then by the end of the period shown on the chart, we're about $55 million. So we're continuing to see steady, sizable increases each year, and it's really in that unfunded liability contribution. Okay, so didn't like that. Okay, so this chart is showing us what's happening with both the normal cost and the member contribution rates, which, as we've discussed, were impacted by the discount rate reduction. So in 17-18, we went from 17.3% normal cost up to 18%, up to 19%, up to 19.7%. And that increase is almost all attributable to the discount rate reduction. We see in this most recent valuation, which again is what's determining what the rate will be for 21-22, that there's actually a decrease in the normal cost rate from 19.7 to 19.3, and that going forward we expect to see continued decreases in the normal cost rate, and that's due to the fact that we have more, we're expecting to see more PEPRA members in the plan over time. That is a lower cost benefit, and it's bringing the average normal cost of the plan down. While our overall contributions we expect to be fairly steady because of increasing payroll, the rate itself is expected to go down in the future. So it is going down from 2021 to 21-22, and that's expected to continue. If we look at what's happening on the employee side, so this is the rate that employees pay. It's a little bit hard to make out what's going on here, but there's the dark blue bar which is kind of behind the other bars, is representing what the PEPRA members pay, and they pay 50% of the PEPRA normal cost. So in 17-18 and 18-19, that was 10.5%. That actually went up to 12% starting in 2019-20 because the normal cost went up as a result of the discount rate reduction. So their 50% of normal cost also went up. So PEPRA members are paying 12%. That's not expected. That isn't changing in 21-22 as a result of this valuation. And at this point, that's not projected to change. The classic members pay a 9% rate as their required employee rate, and then also pay a 3% cost share under the terms of the MOU with the district. So they're really paying 3% out of the district's normal cost rate, but that 3% combined with the 9% is a 12% total. So that's what the employee rates work out to be. So that kind of goes over normal cost. So then the second piece is that unfunded liability contribution. And so the way the unfunded liability contributions work is basically each year that a loss is created, as we talked about, that loss gets amortized or spread over a number of years. CalPERS calls these amortization bases, but an easy way to think of them is like a mortgage. So each year there's a loss, that's a new mortgage, and then you have a mortgage payment over the next 30 years that you're paying. And in the case of their new amortization policy, over 20 years. And those layer on top of each other as new losses get created, or new gains subtract from the total. So the way that this looks is like this. They kind of build on each other. So I'm starting here with this is the combination of everything that happened before 2014, overall net loss. And you can see that even though this all happened before 2014, we're still seeing increases from 17-18 to 18-19 to 19-20, even going out toward the end of this forecast period. And that's because of that. Because it was amortized as a percentage of payroll, so it's basically was amortized to increase at 3.75% each year. So even for those older amortization bases, we still see increases each year, just as a result of the way that they were originally scheduled. So I'm just going to start layering these on top of each other. So this was a mortality assumption update that was made in 2014. So that created a loss. And you can see that that loss initially was a $2 million contribution. It's going to be a $5 million required contribution by the end of the period shown on this chart. There actually was a gain in 2014. So that subtracts from the total amount that's owed. And then in 2015, there was a loss. So you can see that layers on. And then what this light blue is showing is what was the impact of the discount rate reduction. And because that was phased in over 3 years, and each of those 3 years had a 5-year ramp associated with it, you can see that it has accelerated pretty quickly. So it was really less than $1 million impact in 18-19. Then went to $1 million, $3 million, $4 million this year, or excuse me, $4 million next year, $6 million, $8 million, and then it'll be $9 million each year by the end of this forecast period. This was a loss from 2016, and then we had a gain in 2017, and then in 2018, there was a loss that, that was a relatively small amount. So that's about $1 million a year as a result of that loss. And then we get to 2019, which is the actuarial valuation year that we're talking about. So there was a small investment loss, and that does get amortized with a 5-year ramp, but it's so small you can barely see it on this chart. But there was a larger, what they call liability loss. And the cause of that liability loss was essentially actual salary growth exceeded the assumed salary growth, which created a loss. That loss is now, based on the new amortization policy, getting amortized over a fixed 20-year period at a level dollar amount. So it's $2 million next year, and it's going to be $2 million every year for the next 20 years. And so unlike the previous amortization basis, that amount won't change each year. But basically, at the end of the day, the way the unfunded liability contribution is calculated is adding all of these things together, and that results in the total amount that's owed. So if we go back to that original chart here, if we look at the 21-22, so that's the year that these contributions, that these valuation reports are determining the contributions for, that's that $32 million in unfunded liability contribution is really a result of all of those prior gains and losses stacking on top of each other. That's going to get added to the normal cost percentage of payroll, which we're showing here is $13 million, to determine the total contribution amount of roughly $45 million. So I believe that concludes my, oh, actually I did want to mention one other thing, which is that what's not shown here on the unfunded liability is what might happen as a result of 2020, right? So we've now concluded fiscal year 2020, but CalPERS won't actually complete the actuarial valuation for that year until about a year from now. So we don't know what the ultimate impact would be, but we do know that the investment return was below the discount rate. So it was about a 4.7% investment return compared to the 7%. And so that alone would create a loss, which would add to these numbers in future years. I just wanted to make everyone aware that that's not reflected yet in these numbers. And that actually does conclude my presentation, but I'm happy to take any questions.
Well, thank you so much, Amanda. That was very dense and somewhat depressing after what was a fairly neutral first presentation.
Well, it wasn't my intent to be depressing, and I apologize. I don't think there's any way to make it not dense.
No, and there's no way to make it pretty, I guess, either. So, but I do appreciate you going through the details and walking us through that. Any questions from my fellow board members, comments?
Mr. Chair, this is Gay. Hey,
Go ahead,
thank you. I just want to let Amanda know I'll probably give her a phone call and follow up. If not tomorrow, then maybe sometime next week, just for my own clarification and for some future stuff. Thank you.
Sure.
Thank you. Seeing nothing further, our next board meeting is to be determined. Next month, we normally have our finance, not board meeting, but our committee meeting is the second meeting of the month. And the next 2 months, we don't have a second meeting. So we might not be back together again until January. That right, Melissa?
Yes, that's correct. I'll check in with Amanda, and if there's a need for a meeting before then, we'll reach out to the committee members and let you know.
Wonderful. Thank you. Having nothing further, then this meeting's adjourned. Thanks all.
Thank you. Quick technical check, Melissa. We stay on this same Zoom platform for our 6 o'clock meeting?
Yes, our 6 o'clock meeting will be starting in less than 15 minutes or so, so you can stay right.
Thank you.